The world's largest oil reserve didn't fail because of corruption. It fell because of a financing decision that worked perfectly, until the day it didn't. It wasn't a collapse. It was a foreclosure. This is case number 2, the quiet foreclosure of the world's largest oil reserve. An investigation into how a nation can own the resource and still lose control of what that resource becomes. While the world was watching elections, protests, and speeches, the real execution was happening somewhere else, in spreadsheets, compliance systems, and settlement ledgers. In the 1990s, Venezuela wasn't a warning sign. It was a reference model. PDVSA wasn't a bloated state monopoly. It was Venezuela's state-owned oil titan, the financial backbone of the nation, managing every drop of the world's largest reserves. It was studied by emerging economies as proof that state ownership didn't have to mean inefficiency. Its engineers were internationally trained. Its lifting costs were competitive. Its financial reporting was readable, auditable, and trusted. But Venezuela's real advantage wasn't underground. It was above ground. Through PDVSA, Venezuela owned Citgo, a massive refining and distribution network inside the United States. Refineries calibrated for heavy crude, insurance relationships, long-term logistics contracts, banking relationships. Citgo wasn't just downstream capacity, it was access. Venezuelan oil didn't need to negotiate its way into the global system. It already lived inside it. Oil was sold in dollars. Those dollars cleared through New York. Payments settled smoothly. Credit expanded naturally. Nothing exotic, nothing fragile, nothing that looked dangerous. And that's exactly why no one saw the risk. Because finance doesn't fail loudly at the top. It fails quietly, deep inside the machinery that no one watches. This is where the investigation shifts. Oil wasn't just a commodity, it became collateral. Dollars weren't just currency, they became access. And that access created something invisible yet decisive: optionality. Optionality isn't a theory. It's the power to say no, to reject bad terms, and to wait for a better door to open. It is the thin line between negotiating from strength and being forced to comply. As long as Venezuela controlled production, refining access, insurance, and settlement, it held optionality, real leverage inside the system. But optionality only reveals its value when pressure arrives. And that pressure was already there, quietly building, not in politics, not in elections, but in chemistry. To understand the trap, you have to understand the oil itself. Most people imagine oil as a liquid that flows the moment it's extracted. Venezuelan oil doesn't behave like that. The crude in the Orinoco Belt is extra heavy, dense, viscous, loaded with sulfur and metals. At ambient temperatures, it has the consistency of peanut butter. To move it, PDVSA depended on a fragile, high-tech loop. First, diluents, light hydrocarbons injected just to keep the oil from hardening in the pipelines. Second, upgraders, multi-billion-dollar industrial cathedrals designed to strip away impurities before the oil could even leave the coast. Every single barrel depended on this loop. Break one link, and the flow doesn't slow, it stops. Here's the turning point. Venezuela, despite holding the largest proven oil reserves on Earth, was chemically dependent on diluents imported from abroad, primarily from the United States. In the 1990s, this hardly seemed like a flaw. Global trade was open, dollar settlement was frictionless, insurance was cheap, and clearing was automatic. From the outside, the system looked like a masterpiece of efficiency. Underneath the surface, it was brittle, a high-output machine with absolutely no redundancy. And brittleness is invisible for as long as prices keep rising. In the early 2000s, oil prices took off. With them came a surge of revenue, easy credit, and foreign capital eager to get in. Venezuela didn't court investors, investors courted Venezuela. Money circled the country, convinced it had found a permanent bet. That windfall could have been used to harden the system, strengthening weak links in production, securing diluents, protecting the future flow of oil. Instead, a different choice was made. PDVSA's cash wasn't stolen or lost in the shadows. It was redirected openly and deliberately, away from the wells, toward social programs, toward regional influence, toward short-term political stability. The oil kept flowing, and almost no one noticed what was quietly being left undone. At first, nothing broke. Production remained high enough. Prices stayed elevated. The system absorbed the stress. From the outside, it still looked like success. But internally, something fundamental changed. Revenue replaced reinvestment. The system was still running, but it was no longer being maintained. Once a high-maintenance system stops being serviced, failure isn't a possibility, it's a schedule. This is where the numbers stop behaving. Not suddenly, gradually. Maintenance delays became equipment failures. Upgraders at the Jose complex began to choke. Without enough diluents, heavy crude stayed underground. Somewhere inside that system was a senior engineer trained for a chemistry that forgives nothing. He knew which valves couldn't fail and which warnings could be ignored for just one more day. Spare parts stopped arriving, diluents didn't show up, safety margins vanished. Eventually, the warnings stopped working. He left, and when the people who know how to keep a fragile system alive leave, the decline becomes mathematically unrecoverable. Production collapsed. When Venezuela ran out of room in public capital markets, it turned to bilateral deals with China and Russia. Loans secured by future oil deliveries. Liquidity returned on the balance sheet. Oil committed to debt became an obligation. Each barrel pledged was removed from strategy. Foreclosure doesn't seize what you own. It seizes what you haven't produced yet. After 2017, the system tightened through compliance. Global dollar transactions must clear through correspondent banks in New York. JP Morgan, Citi, Wells Fargo. When the U.S. Treasury designates a jurisdiction as high risk, banks de-risk automatically. Algorithms reject any transaction carrying exposure to regulatory fines. No negotiation. As correspondent relationships vanished, the physical infrastructure followed. Without insurance, tankers couldn't dock. Without docking, oil couldn't move. Without settlement, revenue stopped. Venezuela was removed from the grid. To survive, a parallel infrastructure emerged built on trading houses, shell companies, and ship-to-ship transfers conducted far from regulated ports. A system where each workaround solved an immediate constraint while steadily extracting value from the operation. By the time the world noticed, Venezuela still had oil underground, but control had already moved elsewhere. Large portions of daily production were now locked into discounted debt repayment. The Venezuelan state became an operator without cash. They provided the labor, they provided the land, they absorbed the environmental risk, but they no longer controlled the ledger. Venezuela didn't lose its oil. It lost the right to decide what that oil meant. Optionality is control of the switch. And once that switch is flipped, even oil becomes silence. This was the cash files. Case is now closed.